Yeah. All right, everyone. Thank you for sitting through our little bit of technical difficulties there. But we're going to go ahead and get this started. And so to kind of give you guys a little back history of why we're all here today. Many of you know me from the real estate world of working with buyers and sellers and real estate investors and being a real estate investor myself. And so I was presented an opportunity to partner to start and form another business entity called BHR Capital. So we kicked that off at the beginning of the year. And I have Ladder Financial here, who are one of my partners with helping you guys get funding. So what type of funding? So yes, we're going to talk about real estate funding because I know a lot of you are interested in getting started in fixing and flipping, buying a home, maybe even new construction. But many of you have expressed interest in wanting to get funding to start a new business. And so I am bringing you the source of the source this evening for you to ask and bring all of your questions. You can type those in the chat. We have folks manning the chat to answer all of your questions. So who do I have with me? I have Hiram here. He's the CEO of Ladder Financial. I am founder. And so I believe the number is a little bit higher, but at least $130 million in startup loans. Am I correct
Yes,
on that?
yes, and counting.
And
And
counting,
still
okay.
counting. Yes.
And we also have Craig, who is behind the scenes. We're having a little technical difficulties, but he is also the president here of Ladder Financial, and we're coming to answer all of your questions. So I'll let you go ahead and formally introduce yourself.
Thank you. Thank you for the opportunity. Truly awesome to be here today. I really want to make sure that everything that we do, it's all building excitement, because when you know how to get the money from the lenders, a lot of things becomes very easy in how to invest the money, where to put the money, where to find the return on investment. And real estate is the hottest thing right now. Just to kind of give you a little backstory, our business was established in 2019. We didn't touch a PPP loan or EIDL loan. What we really concentrated on was real estate. When COVID was happening, the pandemic was happening, we concentrated on real estate. We concentrated on funding people non-collateralized money, and we blew up. And that's one of the things that we, myself and my business partner, we have years of experience in the recreational, in the consumer financing space of the business funding space, the real estate funding space. And what we always love to do is and we enjoy, is the possibilities of showing you how to be able to attract lenders, not so much for your application, but your pro forma, how to prepare your application correctly, how to be able to secure the money and the funding on the first round, and how to do it in sequence. And of course, alternative and creative lending is one of our specialties, and we love to share it with you. So such a blessing to be here with everybody that's here tonight, so that we can give you the gems and all the amazing backstory of how lenders work.
Thank you. So, okay, where we want to kind of start, because people always think that everything is kind of like a fraud, they don't know what is the truthful, or it just sounds too good to be true. So
Yeah.
when you think about business funding, or they just think like, oh, that worked for them, but it wouldn't work for me. So if there's someone, we'll just start with wanting to start a business, where would they start?
Yeah. So the first thing I always say is, the name is the most important thing when it comes into any business, right? As you continue to grow that business, sometimes in the beginning, before you even start, attracting lenders or even going for funding, you have to establish the name. As you continue to grow the business, the name is what is going to be attached to the EIN. As we continue to work together and maybe show you some other ideas, you'll say, okay, I don't want to do this because my business has enough credit that it can sustain itself on its own. But the name is the most important thing out of it all. Now, one of the things that I always say, go to a trademark website. It's a government website, and you go to the trademark and run a trademark search on the name that you're interested in purchasing, right? And then once that gets clearance, the most important thing right after that is to make sure that you are naming your business correctly. When it comes down to NAICS codes, or SIC codes, right? Where lenders look at that stuff. We a lot of times skip that step. All right. If I'm in the real estate game and I'm flipping homes or I'm doing buy and holds or whatever the case is, Airbnbs or whatever, real estate is restricted market or industry to a lot of well, I wouldn't say a lot, but about 20% of lenders. And then the other 80% is it's just a high risk thing that they don't want to deal with it, right? So you have restricted over high risk. The most important thing here is if I'm going to start a marketing a real estate company, it's not going to be ibuyhomes.com, right? Because if you look at property management, it's a low risk industry because you have the rent rolls coming in. All you have to do is collect the check and make sure that people pay. But if it comes down to anything on the real estate investment side, then that's where you have an issue. So a lot of times you got the name, but making sure that you have the proper name, like managerial or consulting company or enterprises, is the best thing to allocate and properly name your company. So when you go through a lot of the AI, which we'll cover later on, but as you go through the artificial intelligence application, it's not being sent over to the fraud department, or it's not being sent over to the high risk or restricted department and getting the application declined. Because the worst thing is getting the application over to the fraud department and then trying to rehash or renegotiate and turn that decline into approval. The system already said no. So the most important thing here is not only to do a trademark search, but at the same time, make sure that you name your business properly. And then, of course, you follow from there. Don't get the EIN before you have the business established yet, right? If you go and file, doesn't work, then you end up having to do the paperwork again. EIN, business bank account, business telephone number, and now you have a business checking account. And from there, at that point in time, it's just a matter of getting the funding to get put into your business bank account, go and find the property, and now go get some hard money on the back end. So you end up walking into the deal with no money out of your pocket. It's basically under the business.
Okay. So, how important is it that that business entity be seasoned, like established for so many years? So, because you just said that it's best to make sure that you have the right codes attached to it, the right name to it. So if I'm listening to you and I'm like, oops, I have something in the title of my name, and so maybe I need to go open another business entity, is this going to hinder them from being able to get funding?
What the biggest hindrance here is the fact that you actually still have it under your personal name. Time in business is a good thing. However, when it comes down to a lot of these startup companies that have made it and have gotten money from venture capitalists or even private investors, banks are starting to think more of like an investor side of things and say, okay, that's a great industry. That's why SIC codes are important. Time in business is important, yes. When you start getting into the whole details of 5 years in business, I need, a $10 million portfolio loan. That makes a lot of sense. When you're in the startup phase and we're chatting maybe on the realm of $200,000, it's irrelevant. $300,000, $500,000, even $750,000 to get out of a bank. You can have one day with that EIN, one day in business, but making sure that everything is step by step done correctly. It's what we call lender compliance. When I take on an application, I process an application like if I was an SBA lender. The SBA has the most highest level of, I would say, application process than any other type of lending source in the United States. And the reason why is because they have their own internal scoring system and they have years and years of data that they gather and say, okay, this industry here has a high default rate. They don't pay through on the loan. So therefore, we have to minimize this, and we don't want to deal with this type of industry. It's nothing on you. It's just the industry. But when you go at it and say, okay, I established the business correctly, I have my EIN, I have my business checking account. Those are the first immediate 5 steps that the SBA looks at and says, okay, we're dealing with a real business owner. It doesn't matter if it's day one. It doesn't matter if it's been 3 hours that they approved you. We can always get those type of deals funded anywhere from $150,000 to $300,000. It doesn't matter. The most important thing is having those lender compliance items that lenders are looking for to be able to secure the funding with them.
Okay.
Or even, I'm sorry to interrupt you, but even the business may not be established yet, and you're trying to start a business, sometimes looking at you a little ahead of the game using your resume. Like, I've worked for the post office for 10 years.
Mhm.
You can combine the 10 years of resume experience added to that EIN, and they look at it. Sometimes we'll ask people's resume. Give me your resume. Because your resume says you have the ability to stick with it, even though things are tough, even though we're creating families, starting families, and it shows that you have stability there. And that's one of the things that we also point out through the funding process, if you will.
Okay. So there's always a question when it comes to personal credit and the business credit. And um, maybe someone has a credit score that's much lower, their personal credit score that's much lower. How does that impact them getting funding on the business side? Or what steps should they take?
All right, so this is one of the little geeky things. I got to do the little geeky, little signal here. And all right, so banks, if you know the real estate game, we always talk about we always bring up the word comps, right? Either you want to get a mortgage, or either you're trying to do, real estate, have a great application to show a real estate investing lender, okay, these are the comps. This is what this house is worth. That is what that house just sold for. And this is what we average it out. When it comes down to the personal side, you may be struggling to even get a car in your name. You may be even struggling to get maybe a mortgage in your name. You haven't even had a mortgage ever before in your life. I always like to go through the process, which, you know what, a lot of times, if you can divorce yourself financially from the business and start building up the comparables of loans under the business EIN, more lenders are going to help you, and your business is going to be more in favor of getting funding than you personally. Now, I'm always going to give advice, right? Because a lot of times in the beginning, when you're starting a business, is either we put food on the table, or I have to pay this $300 fee, or this, appraisal, right? So it's very important that you balance it well. But lenders like comps, and I always say this, you can find about 3 different lenders that will give you, let's say, anywhere from $5,000 to $10,000 on the personal side. They go as low as 540 or 560 credit score. The rates are not going to be, they're not going to be cheap. However, you take that money that you got and borrow from that lender, you put it into the business checking account. You're going to ask for the lender to provide you a secured credit card under the business with the money that you just borrowed. Every monthly payment that goes to the personal, you use the secured card to pay down the monthly payment on the personal side. And every monthly payment that goes on the business credit side, it shows up as unsecured. Perfect payment history. So now you almost have like an identical Social Security or credit profile that you can work, maneuver, alter, increase favor, and also get funding for without having to use your own personal credit. So now what that does is that it decreases your liability on your side. You work on the personal side. So when you start graduating and getting better deals, because hard money lenders, they don't care what your credit looks like. Hard money lenders don't even care that you even have a job to pay this back. That's called collateralized lending. They already have the backbone, the meat, it's the property. If you miss a payment, then unfortunately that's their money now. However, on the personal side, you remove that, build it under the business EIN, and now move forward. And now you'll start seeing within a 90 to 120 day time frame getting credit card offers. Now you start getting term loan offers. And that comparable on the business credit, a lot of lenders will give you 3 to 5 times that amount. 10,000 times 3 is 30 grand. 10,000 times 5 is 50 grand. If I'm going to look at a fix and flip, check this out. It's a $100,000 property. I'm going to put 10% that the lender wants plus closing. I'm going to go and find the property. Then I'm going to go ahead and get a hard money lender to give me 90% plus 100% of the rehab. And I just walked into a deal without even tapping into my own money with a credit score that may not be suitable if I was to go get a personal loan on my own, or even a personal car on my own.
Wow. Wow. That's really interesting. Someone had put in the chat they were confused by this. So I want to kind of roll it back a little bit, so to make sure that everyone is, because that you really just gave a good down in there. So I want everyone to really understand what you just said. So basically, he's saying if you're an individual that has some credit challenges, you're going to be working on establishing your personal and the business really at the same time, right?
Correct.
So you're getting that personal loan. Are you starting with that personal loan?
Yes, correct. So, and anybody that has any confusion or anything, so we can always break it down. But our team can always chat with you guys and all that good stuff. But it's really simple. You get the personal loan first, because remember, we want to work on your personal credit. As you're going through the process and finding lenders and lenders finding you, you want to work on the personal credit. So you're going to borrow the money from a personal lender, which they can go as low as 540, 560, depending on income, right? Income is a big factor when it comes down how much money they're going to loan you. Once you have the $8, $10, or $12,000 that average that they provide you in loans, you're going to go and get the business established. You're going to open up a checking account. You can use PNC, you can use Wells Fargo, you can use Chase, you can use a lot of different, you can even use a credit union. They're going to provide you a business checking account. While you're opening up a business checking account, you're going to say to that banker, hey, do you have a secured business credit card that does not have to run my credit, that does not have anything to do with my credit? I just want to build a credit profile on my business. Absolutely, we have a secured credit card. Great. The money that you got on the personal side, since it's burning a hole in your business, on your personal checking account, you don't need that only paying you a 0.25%. You want to put that in the business side where you can get a 0% card or maybe 5% card. And anytime that you use that credit card, it'll show up on the business credit report, Dun & Bradstreet, IntelliScore, Small Business Financial Exchange. Those are the three major data gathering companies, credit reporting agencies on the business side. Once your score starts creeping up to 70 and 80, you will start getting a lot of offers from the lender where they will 3x it or 5x the amount that you have on your business credit card. The great thing about business credit card, or business trade lines or loans, they don't care about utilization. It doesn't show up as a secured card like it does on the personal side. And inquiries is not a big factor. Once again, you would take the money on the personal, put it on the business checking, get the secured card, start utilizing it. And the greatest thing is that you can write off all the expenses that you put through the business, opposed to if you use it on your side, you really can't write off a lot of things until the end of the year and potentially write up maybe 10%. But that is the strategy. That is just the first part of establishing your personal and establishing the business. Once you have that secured card, you may have $10,000 on a secured card. You may have $20,000 on a secured card. You now go find a property. Real estate fix and flip for me, those are really quick because I can get into projects and leave. I don't want to marry the property. I don't want to live in the property. I don't want to have to deal with anybody calling me at 9:00 at night or whatever. Hey, my plumbing is gone, right? We will look for the property, let's say somewhere around $80,000. The hard money lender is going to give you 90% of that. So all you have to come to the table is 10% plus the closing. And now the hard money lender is going to close on the deal for you, help you out. And now you got your first property under your belt without having to utilize your own personal money. Step by step. It's really crazy how I'm breaking it down, but it works. That is the easiest way you can get into real estate without having to utilize your money, even if your credit is going through some things right now.
And guys, I know that still may be a lot. We do have a link that we'll provide to you in the chat. I will post it in a little bit. So you can schedule a call to kind of get the ball rolling in there. The link will just take some basic information from you. And then from there, they can help you get in position for the type of funding that you could qualify for. But with that, I know a major question is always pulling credit. People don't like pulling their personal credit because they hear that it will drop their score. But we have big news for you guys. So what happens when they go through that approval process, start that process with you?
Yeah, so we always make our office running joke is called like inquiries on so 1980s, right? So 1990s. You know, it's just one of those things that with so much technology nowadays, and with people, let's be real honest, a lot of people like almost like give their information easily. I mean, there's so many data gathering companies from Lexus, to companies like Paydex, from companies like MX, like Plaid. There's so many different companies that gather data and then sell it to companies that like need funding, right? So let's be real, artificial intelligence has really opened up the waterfall, if you will, which is in a good way. You really don't need to put a hard inquiry on anybody, especially with the systems we run. The fact that I can look at a identity IQ score or look at the experience in all three scores and my system shoots out a quick pre-approval, that's what we're looking at right now. We don't need the hard inquiries. Like we can go window shopping, and until I don't like it, I don't go in the store. It's almost the same thing. We shop for different lenders with 300 to 400 lenders on one shot. The system then dissects that to, okay, is it local? Is it a credit union? Okay, then we have to go local. Is it a regional lender, only works in tri-state, New York, New Jersey, Connecticut? Then we can only stay there, but they only want TransUnion. The TransUnion is strong, the Equifax and the Experian is not. So the system is going to say, okay, we don't want any Equifax and Experian pulling lenders. And then now the system picks up on the algorithm and shoots up a display of different lenders and says, okay, here's your top 3 lenders that is going to give you 100% approval ratio. That's AI. Now, obviously, every bank is going to do their due diligence according to the Fair Credit Reporting Act. They're going to make sure that they're going to pull the hard inquiry once you accepted the terms to make sure, okay, you are actually a real person. That's how they fight, identity theft. You're actually a real person. System pulls the final 3 inquiries. But the great thing is that let's say that you do get approved for business credit. Although there's a inquiry, let's say Chase Inc., we get you approved for $80,000 on one card. Okay, that's great. We can always call the Experian later and say, hey, I need that moved because that is not an inquiry that's on me personally. And now you get it on the business, it doesn't co-report solely into the business, you can have that inquiry removed. But nowadays, with AI, no need to do any type of hard pulls, if you will.
Okay, that's wonderful news. So you don't have to worry about that piece of it. I know we touched on it a little bit, but just those lender guidelines, like what are they looking for? Because some people may still feel a little reserved or holding back from wanting to go ahead and apply. So what type of lender guidelines are we looking at? Am I frozen?
I'm sorry about that. I think I froze up a little bit.
Okay.
What was your question? One more time, I apologize.
No, you're fine. The lender guidelines. What type of lender guidelines are we going to be looking at? Or should we be concerned about, or when should someone feel like it's time to wait?
Yeah, so as far as lender guidelines is concerned, waiting and delaying, Wells Fargo says it best. The quote is, the longer you delay the fact of funding yourself or your business, the longer you're gonna reap the benefits of funding, right? Or reap the benefits of divorcing yourself, or reap the benefits of anything. So if funding is one of those things that you are kind of scared of as a business owner, we don't discuss rates. Like for example, for me, if I need a quick $500,000, I'm not going to discuss that as 9%. Like that was more like the personal mentality that I had running my budget in the house. You can't run the budget of a business the same way you operate, and you penny pinch in the house. Let's put it to you that way. But I think the most important thing is when it comes down to lender guidelines, lenders like to see three things. It's called what we call a 3Cs. Either you have cash flow, either you have credit, or either you have collateral. So cash flow will any day, like they say, cash is king. Cash flow will always be the first thing in mind when it comes down to lenders. So for example, we got a young lady approved the other day, 602 credit score, repo 2.5 years ago. We got it. She's past the 2-year mark. We were able to get her $22,000, right? Well, that's good for somebody that, right now they can't get a credit card on their own, that amount of money, because we understand the rehash process. But a lot of times what lenders want to see is that the money that you're making, cash flow, or you personally, they want to make sure that you have enough money to debt service. If the lender's going to look at two things, payment to income and debt to income. If your debt to income is too high because your utilization is heavy or whatever the case is, obviously we're going to advise you to do a PYN, and we can cover that later on. Borrow some money, park the money, and then go into a different direction. But if you get into the position of payment to income, if you make $50,000 a year and the lender says, well, we only want to give him 10% of the payment to income, you basically take the $5,000, which is the yearly 10% of 50, you divide that by 12, and then they say, that's the payment we want to see him every month. That's how we negotiate with lenders when we get a decline and we turn into an approval. So payment to income and debt to income has to be in line. So the rule is 40% utilization if you have revolving accounts or line of credit, revolving credit cards. If you have a $10,000 limit, you want to make sure that you don't owe more than $4,000 on that card. If you submit your application to us, we'll review it. We'll say, okay, this is what you need, pay this down. I can get you a loan to pay that down and then increase your limit so that I can increase your score, so then I can get you some more money, right? That's one concept. But then the payment to income is the part that we can work with the lenders and show maybe a pay stub. They make this amount of money. They've been working for the job, or they have business revenue and they're making this amount of money. When it comes down to the inquiries, we typically don't want, because the lenders don't want, more than 6 inquiries within a 12-month period. Keeping inquiries down shows the lender that you're not going crazy or going too fast on trying to build credit or borrow money. When you give your application out and there's hard inquiries, but there's not the trade line on there, that's when lenders start to worry and say, hey, I think we have an issue here. There's a concern. They start getting a little conservative and they don't give you the approval. Anytime you have an inquiry, you should be able to have a trade line open within 2 weeks in order for it to show that the inquiry is actually well spent and it's an established account. And then the fourth thing I also want to cover with you is I think it's very important, especially with AI. If you have an old address, you may have 2 or 3 employees on there. You may have a suffix that you're not putting on your application. You may have a little too much details on the top of the body of your credit report. Before you move forward with any lender, especially that 9 out of 10 lenders use AI, you want to make sure that you clean that up before you apply. And of course, if your credit is frozen or you have a freeze on your account, before the bank pulls the inquiry or the soft pull or whatever the case is, get that unchecked or unfrozen. That way they can pull and not send your application over to the fraud department, which 9 out of 10 times is very difficult to try to get it overturned at that point in time. Score, I would say the minimum to start looking at is at least a minimum of a 610 to 620. It's a good spot. Typically, you can get about $20,000 to $30,000 with that type of score. If you're sitting on a 680 to a 720, you can typically get anywhere from about 40 to about 180 grand. And then if you're sitting over a 720, typically you can get up to $300,000. And if you have 2 people under the same EIN, you can pretty much double that.
Okay. There was a question someone was asking as far as showing your cash flow. Are they just going to want to see bank statements, or is there any other documentation that they'll need?
So banks like to ask for every single thing, right? A lot of times what we do is when we build in the case with the lender, we like to say, okay, we're going to provide you what it is, but the financials got to look good. So when it comes down to showing proof of income or proof of revenue, a lot of lenders, if it's through the business, they're going to want to see a minimum of 3 months. The 3 months should show them a good consistency of what you're making. Now, some business are low ground, low revenue during the holidays, right? We just closed on a company that does ski resorts, and they're big, right? But that's when they make their money. In the summertime, they can't do anything. So in the summertime, when they first came to us, we're like, okay, you're not generating any revenue. I get you want to ramp up, but your season is when the flurries fall down from the sky. So that's typically September. What I told them is, come September, we'll show September, October, November with revenues, and now we'll go and approach him on the business side. Now, thankfully, he was able to get himself $180,000 at 0% credit cards, which a lot of people are like, well, I have every credit card. I don't need any more credit cards. But that is what was able to get some of the things that he needed in fixing of things on the property to be able to get in without any problem or any. When the other type of lending came in December, well, it was a piece of cake to pay that original revolving lines down, and then now utilize those funds for other things. Business side, 3 months of bank statements and a fully executed credit application. On the personal side, if you're sitting at a 680 and above, they don't even ask for financials. 675 and above, to be honest with you, they don't even ask for financials. They're like, okay, give me your EIN, give me your driver's license, let's close the deal. When it comes down to scores lower than that, they're going to ask for what they call POI, proof of income, proof of residence, and a driver's license. Proof of income is going to be 2 pay stubs within that month if you get paid bi-weekly, or 4 pay stubs within that month. And then proof of residence, real simple. All you have to do is just bring in, a utility bill, a cell phone bill, with a major company, and then your driver's license. Some programs in that 650, if it's a term loan, they don't even ask for proof of income because it says it right on your credit report. Works for the United States Postal Service or works for UPS or FedEx, and that system will automatically pick that up. They'll even pull some information and reports from the IRS, and they match it. All they need is just for you to just show your driver's license for identity purposes.
And if you're self-employed, would it just be bank statements, or would they want to see tax returns?
So sometimes they will ask if the business is very new. Again, with a 680 and above, they don't care. They won't even ask for any of that stuff. Under 675 and under, they will ask for a 3 months bank statements. If they're not convinced because there's declining revenues, then they will ask for a year or last year's tax return.
Okay. All right. So I have a couple scenarios here that I just want to kind of run through to see if these are some of the type of businesses that folks will get funding. So if someone wanted to purchase a franchise business, is this something that they can find funding for? A Subway shop, or I always wanted to open a Chick-fil-A, but
Yeah, you chance of opening a Chick-fil-A, and we've been through this in the past. You might as well win the lotto. Before you can open a Chick-fil-A, you'll win the lotto before that, because it's really hard and intense to do that. But I'm with you. Let me know when you get the certificate, and we'll definitely invest in that. When it comes down to franchise, I got to be very honest with you. You got to know which one to go in. You got to do a lot of good diligent work in making sure that you're finding the right one that fits who you are. And believe it or not, a lot of franchise purchasing and acquisitions, they offer their own financing. They typically want to see a 700 credit score, and they will pull a 5-year history on your personal credit to make sure that there's nothing on there. Back then, they used to pull, when I'm saying back then, it's maybe 10, 15 years ago, they used to pull a 20-year report on the person who's looking to purchase a franchise. But let's talk about a Subway, or let's talk about 7-Eleven. You know, we had discussions the other day about 7-Eleven. You get 50% of all profits. 7-Elevens are good when they have a gas station attached to it, not when they're standalones, unless you're in the middle of a very small town, one street light, one church, one Walmart. That's a perfect standalone 7-Eleven. However, when it comes down to that, they want to see liquidity in the bank account for about 90 days. So the money's got to stay in that account for 90 days, and they want to make sure that it's seasoned. When it comes down to funding, the best solution for that, if you are sitting on a 675 and above, is revolving lines of credit. Let's say I get you a $100,000 Chase card. Let's say I get you a $100,000 Bank of America card. You can liquidate that card by creating a vendor inside QuickBooks, inside ADP, Reynolds and Reynolds, or whatever tax software you use. By creating a vendor, you're now liquidating the card, and the money goes into your business bank account. Y'all follow me? All right, this is part two. All right, if I get you a $100,000 Chase and I get you a $100,000 Bank of America card, you're going to create in the system. If you just pay the $20, it's well worth it. You're going to create yourself as a vendor or your business as a vendor, and then you're going to use that card on file to pay that vendor for the services. Wink, wink. This is how you pay for your GC when you start rolling. Your GC wants to get paid in cash. Side note, don't pay him all the money up front, because they slow down the process and they take their time and start getting on other projects. That's a different webinar. But when it comes down to that type of funding, you want to make sure that you have money that is tracked. That's what they want to see. They don't want to have to go run OFAC on you. Is this money laundering? Are you part of some sort of list that we don't approve? And then once it's seasoned, now you can go through the application process. But I always recommend a revolving line of credit, or a line of credit or a term loan that you can put that money in there. But when it comes down to term loan or a traditional line of credit, when you pull the money, the rates can be 11%. You're not making a profit yet.
Yeah.
Why pay interest until you actually get approved for the franchise? That's the other thing. Possibility of what are the ratios of application to closing ratios when it comes down to a franchise? Is the application ratio to closing ratio 99%, like Chick-fil-A gets? They want everybody to open one, but the closing ratio is like 0.50. So that's not a good franchise to look into. Revolving lines of credit gives you the flexibility and the breathing space of 0% for 12 to 24 months. So if the deal doesn't fall through, you only have 1% of the monthly payment to pay back. The money that has been established in your business checking account, you're going to take the monthly payment that's already there, and you're going to pay back the minimum payment to the credit card company. But it's very easy to be able to utilize, especially when it's 0%, because there's no interest kicking in until you have enough time and traction to say, okay, I want to move forward with that. They approve your application, and now we're in business. Not to mention, if they only want $80,000 upfront from you, you still have another $120,000 to play with. Payroll expenses, taxes, and all the other things that you need to secure 6 months of operations. You're going to need an attorney. You're going to need an accountant running your books. Sometimes people say, I only need 50. Says who? Get everything that you can possibly get from the lender, and the extra is the cushion to be able to pay them back with their own money. It's knowing how to be able to use money. It is not the root of all evil. It's a tool. You just got to know how to use it.
Guys, he's given so many gems on here, and it may be a really hard to absorb everything that he's saying. And you don't need to have it all figured out right here on this call. We're all here to help support you, kind of create that strategic plan for you and your business so you can get going. So don't feel so overwhelmed that you get paralyzed and not want to do anything. It's about having the conversation. You've been introduced to these concepts. It's about then having the conversation about it and then executing on there. So we will have a link here shortly for you, so that you can kind of book a call to get more information on there. There is and just so we're clear, we just talked about a franchise. So we all know that real estate is a non-issue. We can get funding for real estate. But there was another question, and I know this is probably coming from a young lady that I had a conversation with yesterday, and she's into the trucking industry. And I know she has a fleet of vehicles. She does a lot of dispatch out there. And what she said yesterday was that she has a lot of people that also want to get into the trucking industry. And she's asking, is that considered a high risk business?
Yes, yes. So trucking is a high risk industry in general. Why? Because you have your Swifts, you have your Hunts, you have all these major companies that have tremendous amounts of fleet, thousands and thousands of trucks on the road. They can go from regional to OTR. Regional is, just a little area to like over the road. I'm in California tomorrow, back in New York, next week. So in order for, if you miss a payment on that truck, like, how am I going to go find it? Right? Like, the repo man's got to, his American Airlines is going to be astronomical trying to fly to places. Right. So that's why the trucking business is kind of tight. Not only that, the margins are kind of slimmed down because you have major companies trying to put things together. Not to mention freight brokers are out there, trying to do their thing, swing things this way, and so on and so forth. So it is a high risk, not restricted, but a high risk industry. What you do is, just like I was mentioning in the beginning, is when you present the application to the lender, you're not saying idrivetrucks.com. I haul for you, Inc. You want to make sure that you it may be just a TRS management company. TRS might be your initials for the lending application. As far as the business, how you DBA it and how you represent yourself to people on the outside, that's a different story. But the fact that you're structuring your business correctly as an enterprise or management company or whatever it is, do your due diligence and make sure that it's structured correctly to make sure that you have the ability to get funding without any hesitation, right? So if we look at a company like, let's say, a Mulligan, right? They fund deals. Mulligan won't touch a trucking company until it has 5 years under the belt. If you're starting out, if people want to get into the game, I'm going to go and get a revolving line of credit of $100,000. I'm going to go get 2 Cascadias. I'm going to go get 2 drivers, and I'm going to have them 2 drivers go back and forth and do whatever I have to do. And then I have an extra $20,000 in cushion space to be able to take care of overhauls, to be able to take care of maintenance, be able to take care of anything that is mishaps that I don't know. Insurance down payments are ridiculous when it comes down to the trucking industry. So the most important thing, yes, you can get funding for that, but you have to structure the business correctly and make sure that it's done correctly so that you are not facing lenders. When we look at the funnel of how many lenders I have, and then you start to kind of, then it narrows down once you say the word trucking. So having the name right off the bat correctly, managerial, enterprises, consulting, right? I always thought my real estate people, my trucking people, what do? You're consulting. You're constantly talking to people on how to do what? Buy something. You're giving them advice. I'm constantly, as a freight broker, I'm constantly giving advice. Take this load, drop it off here, pick that one up, and it's easy. We save money. We made money. Let's go. Let's do it again. Watch, rinse, repeat. So when it comes down to the trucking industry, yes, structure correctly, funding won't become a matter down the road. Now you start getting 10, 15, 20 trucks. We're now going to elevate your business and start talking or start conversations with lenders that only concentrate on you, because either it's time in business or fleet. Time in business or collateral. Remember we talked about is one of the C's. So if you have collateral, 10 trucks on your belt, they're all paid off. Why don't we get you another 20 more trucks? Can you get drivers? The problem at that point in time is I can't get drivers. Once we scale people in the trucking industry, we've done it tons of times. Once we get you there, it's like the concern at that point in time is I can't get drivers. I can't get people to deliver loads. So hopefully it'll be a good thing for you, because 20 trucks is nice, but you do, obviously a business has issues when they get to trying to get to 100 grand. Then they have issues trying to get to 7, the growing pains. Then I'm making $10 million a year. There's always growing pains to everything, but structure the business correctly, you should have no issues whatsoever.
Okay. So, but I do want to touch on real estate a little bit more. That's my love, my baby, my passion. There was a question in the chat about that, asking, is there a such thing as a no doc loan, is what they were asking.
Yes. The no doc loans, banks are still going to want to say, well, we need to know who you are, right? Eventually. I mean, you can't go and register, even though your car is free and clear, you can't go and not drive it around until you register the vehicle. You got to have a registration. Doesn't matter what state it is. When it comes down to no doc loans, there is going to be a little bit of representation. It's more like, and I think a lot of people have taken that concept and have ran with it, because Wells Fargo kind of was testing some things out in the beginning, where it was a no doc loan up to $50,000. I don't know. You guys probably see that all the way on Wells Fargo on YouTube. That doesn't exist anymore, because they started asking for, let me get a financial statement. Let me get a PFS. What's a PFS? Personal financial statement. I want to see if you have investments. I want to see this. Make sure that you can pay us back, debt servicing, right? So as far as no doc loan is concerned, they will still require you to show at least one pay stub, a driver's license, and a utility bill. I wouldn't call it completely no doc, but when it comes down to revolving lines of credit, is the lowest documentation type of loan there is for anybody on the personal or the business side. Because all it really truly is, all you got to do is give your social, give your EIN letter showing that you are the owner, and the application process is the most easiest. In addition to, I also want to let you know, a lot of times what we do is we use HHI, household income. If I'm only making 50 grand a year, or I'm only making $25,000 a year, but my wife is making 75, the application says household income. It doesn't ask me for my income, not only mine. So everybody over the age of 18, we're going to add all that income and revenue and put it on the application. What is that going to do? Increase your limits on the first shot. And what do we do with the extra money? We invest it, or we pay them back until we find the proper investment, franchise, trucking, real estate deal that comes our way that sounds sweet, and we know we can make a return within 90 days.
Very good. What if we don't have a utility bill in our name? Could I use a credit card bill?
Yeah, credit card bills are good. Yeah, that's one of those that that it's kind of like a bank statement. It almost works like a bank statement, because the bank already verified you. The bank already ran your social to open up an account. You went through a paycheck system for them to open up an account. So a credit card statement is good, can be utilized as a proof of residence. Yes, perfect.
Okay. So a couple questions here in Ohio. We have a very affordable housing market. So you can find, we're like the place where investors kind of flock to buy investment properties here in the Midwest. So we might see properties at 50,000. Honestly, we can find deals at 20,000. It might need a lot of work. What is there? A lot of lenders don't do those minimums, because I guess it's just not enough meat on the bones for them to make money. What are the minimums that they would be looking at?
So there's lenders that'll do, at that point in time, I want you to just hear me out, right? Because I don't want to scare anybody, but I want you to think big. I'm always going to tell you, think big. Why buy one? Why can't we buy 3?
My kind of thinking.
Right? Why buy one when you can buy 3? Now, my first approach is always going to be a credit union, which we have a lot in. I mean, each state we probably have about 2 to 3 different credit unions that we use, depending on the state, right? You can be an out of state investor and still be able to find, because what credit unions say on their application: you work, worship, or live.
Mhm.
Real estate deals is a gig, so we're going to be able to get with that and show, hey, we're buying property here, and we're gonna live here. Great. So now that opens up that jurisdiction and that funding piece for you, because you're either going to work, worship, or live. A lot of times, what I like to do with credit unions is I'm not going to tell them that it's a real estate gig, because then they're automatically going to send me to a mortgage guy or a mortgage gal. What we're going to say is this is going to be non-collateralized working capital to start a business. That's going to be on the application. Non-collateralized is going to be the fact that if I get $100,000 and it's only 7.9% for 60 months, I have a small payment. You can do the math after we finish, right? But 100 grand at 7.9% for 60 months is not a bad payment. Then what I'm going to do is not only am I want this small $50,000 property, but I want $150,000 worth of properties. The 100 grand is so that I can have enough money for down payment and enough money for my closing costs, and a little extra money in case my GC didn't calculate correctly, and then the hard money lender paid for the rehab, but they already short. I got shorted on money, so that's extra expense or unforeseen situations. The moment that you flip those homes, or either you put them on rent rolls, especially multifamilies, right? New York right now, I got to tell you, New York right now, they have a third floor, a second floor, a first floor, and they gutting out the basement. Now they have 4 tenants, and they're making a tremendous amount of money on multifamilies. Your call, just figure it out, right? But the most important thing here to do is, when it comes down to that approach, I'm going to look at a credit union, because credit unions are going to give me favorable rates based on membership-driven banking, not board member banking. Once I go in, a lot of questions are not asked the way that you would sit down on a conversation with TD Bank. TD Bank is going to want to know everything about you. Credit unions is like, okay, what do we need the money for? All right, let's do a quick soft pull. All right, boom, we got you. I get you $100,000. Does that work? Absolutely. Deposit in the account. Let's start working on the deal. Which I think I kind of chatted with you a little earlier, Andrea. I think one of the things that, when it comes down to real estate, and we've done this tons and tons of times, is the fact that we go out and find a property, we fall in love with it, we know we got it in our minds. Okay, I can make minimum 15% profit on this, or I can make 40% profit. You start making the numbers, putting the numbers together, and then now we go to the funding piece, and then that lender says, well, we want 25% down. You don't qualify for 10%. We don't qualify for 90% LTV, loan to value, right? 100,000, 90%, 10% down, they want it. What if you now have the funding for it? You get the 100,000, the property comes second, because out of the 100,000, back to your scenario, a $50,000 home, I can put $25,000 on there. I don't even need to go to a hard money lender.
Yep.
Because I'm with the right people. I got the right GC on my back pocket on speed dial. Hey, man, come in. Go check it out. What do you think? Yeah, it'll take about $18,000. Worst case scenario, what's it going to be? 22. Perfect. You already have 100. The monthly payment on a 7.9 for 60 months is cheap money. And then if you decide to flip, that money builds up quickly, and now you move on to the next one, to the next one, to the next one. But it's always non-collateralized money first, which I call the down payment money plus closing. The property second, because now you know what you're playing with. Hard money lenders are like 7-Elevens. They're in every corner in bodega, like New York. They're everywhere. You can find hard money lenders everywhere. And once you piece it all together, it just becomes a perfect marriage, because you're going through the right proper steps, and you know what's happening ahead of the game before you get stopped and say, well, no, you don't have enough, or we want more.
Did you just catch what he just put down there?
I hope I'm keeping him awake. I'm sorry if I'm not.
He just gave another whole play if you're looking to get started investing in real estate. Again, it's just about having a conversation. Everyone is in a different place in all of this. And so we have to have individual conversations with each of you to kind of build that plan. For some of you, you may need a little bit more time, but that's okay. At least you know where you're at and we can tell you where you need to go. So that way we can start generating some money down the line for you. So you can't be afraid and just automatically thinking like, oh, I can't get approved. You don't know that. Everyone's situation is a little bit different there. So if you're thinking about getting, you want an Airbnb, you want a group homes is really big right now, and your fix and flips, you need to acquire the property, and you need the renovation money for that. We didn't really talk much about that. What does that look like for acquisition and the renovation money for that?
For just acquisitions in general, or just in real estate?
Just in real estate, like doing a fix and flip.
Yeah. It would be a very similar thing when it comes down to rehab. A lot of times, what the lender is expecting is for you to have a GC that is qualified and say, yes, this is what it is, right? Because the lender's going to make you run. I mean, some lenders can be like, hey, there's no appraisal fee as long as you close. If you don't close with us, then we're going to want our appraisal money, right? But let's say the average appraisal right now, I'm kind of seeing anywhere from $300 to $400, $450 is the average. Once you have that ready and set to go and you send that over, it's pretty much 100% of the rehab. Some lenders will even go 125% of the rehab. Like if you go on really big projects, like I want to buy that whole superplex. It has a mini supermarket. It has a salon. It has a United States Postal Service or something like that. You can go into those, and once it appraises, then okay, we're rocking. Most of those, that's more than the development side. Like right, I'm talking about going big. That's when you really start going into like development, right? That's when you know you made it. Like I'm going. I have 225 acres, groundbreaking. I'm about to put 285 single mother properties here so that I can get paid from the government, right? That's the kind of stuff that you start really going in. And that's why, going back to a little bit, connecting with a lender and establishing a relationship with the lender so that now they give you an open checkbook after 3 to 5 doors, because now you've proven yourself that you can actually do real estate and profit out of it. That's what you want. Once we help you making the connection with that lender, you continue working with that lender. You continue establishing opportunities. In a matter of 5 years, you can be opening up a metroplex with a bowling alley, a movie theater, and all that good stuff. And they're just throwing money at you. They know you have experience. They know you have a team, right? That's eventually what we want, we want you to go. But as far as acquisition is concerned, or anything is concerned, I always got to say, you got to make sure that you have the right people in place. And when it comes down to the rehab portion, lenders just need that stamp of approval to say, okay, this property is worth this. They look at the comps, and they now can give you funding based on what is in the area.
Guys, we have officially moved into the no excuse zone.
Listen, my thing for this year is more in 24, right? You got to do more. I mean, it's cool that we did that in 23, but it's more in 24. It's the new thing. And a lot of times that I'm chatting with people either in groups or on stage or whatever the case is, it's like, that's cool. You just, what is your 6-month plan? I just want to flip a house. Just one? Why not 5? I mean, you got all these people out here buying the whole block. Why can't you? I'm giving you the lender. I'm giving you the lenders that will continue to provide you the funding that you need. So once you have the lender and you have them in your pocket, it's pretty much unlimited funding once you get the ball rolling.
You heard it from Hiram, and you're hearing it from me. Go bigger. That is our goal for the rest of 2024. I'm going to try to hit this reclaim post. I'm kind of scared to do it. Because I can't type in the chat. I want to get this link to you guys.
Okay.
we have a couple of our team members on here. Oh, I think I got it now. We have a couple of our team members that are on here that can assist you guys. I'm going to put this link in here. That is the link that you would use. That is just a questionnaire form. You will fill in your information in there. Once you get to the end of that, you can schedule an appointment and you can talk to the team. They will get you all of your questions answered. I will then follow up with you guys as well to kind of talk about that strategy and plan. Where do you go next? So if you're thinking about investing in real estate, starting a business, we have the funding. We brought you the people. They are right here. So you don't have to be scared. Everyone has to start somewhere. And if you need a little work, we're going to figure it out and get you on that right track. Anything else you want to share? We just wrapped up about an hour on here. I'll make sure if you don't get a chance to answer your questions here, you come back to me later. I will get those answered for you. I'll sit down with Hiram and we'll get those answered. But is there anything else you want to share?
Yeah, I want to reiterate again. There's a lot of lenders. There's about, I think, up to this point, there's 4,460 lenders throughout the United States. This is not talking about hard money lenders, just in people, just banks that you can walk in today and potentially get funding with. Now, one thing that I will say, because of AI and how long we've been doing this, we process over thousands of applications on a monthly basis. We have our own little book that shows all the lenders and criteria, where they pull from, what they like, season money, how many inquiries, all that good stuff. Our team is dedicated to making sure that we give you a free lendability review. It doesn't hurt you. It's not like walking into a lender and they're looking at you like, what's your name? No, you already established a relationship with me since I'm here today. Hey, I heard Hiram. Hey, I heard Andrea, right? We're here. So our goal is to make sure that we give you all of the information that you need so that then you can make a better buying decision or purchasing decision or business decision. So the link is there. Fill it out. Connect with our team. If we can't get funding now, we want to provide you a game plan. This ain't Credit Karma. I'm not trying to give you your credit score. You don't need to check in with me for your credit score. You probably know this, right? What I am here to give you is the game plan. Here's the secret sauce. All right. We're going to apply through here, but I need you to pay that $300 Credit One card down. And if you pay that $300 credit card down through Credit One, I can get you $14,000, right? That's the strategy that we want to make sure that we do. So establish a relationship with our team here with us. Let us help you out. Let's build out your portfolio, and let's just continue to do more in 24.
And did you guys notice he hasn't requested any money from you at all whatsoever?
Yeah. Send your payment $29.99 right now, but wait, in the next 10 minutes we'll include the knife set. No, that's not what we're doing here. We're really, really, truly passionate about what we do, and that's what we're here for. So we really, really, truly look forward to speaking with you guys and making sure that your goals are our goals.
All right, you guys, there you have it. You know, if you didn't get a chance to answer your questions here, again, a replay of this will go out. You'll have it tomorrow. It will go out once it kind of finalizes. Shoot me a message. I will be happy to get those questions answered for you. Go ahead and grab that link that's in the chat and fill out that form in there so one of the team members can reach out to you. Thank you, Craig. Thank you, George. Thank you, Hiram, for joining me this evening. You know, I know this is probably family time for everyone, so I truly appreciate you joining in, trying to connect and get this information to, you know, my audience here. So I appreciate you guys for that. And everyone else, have a wonderful night.
Thank you. Thank you for the opportunity. Good night, everyone. Take care.